Our 5-year fixed rate mortgage is dead. As well, are we building enough homes? And the government is giving towns money to build new homes. Is this enough? Well, all this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
Hey, Gary, fantastic.
You were a traveling, I want to say vagabond, but it wasn't vagabond. You were traveling all over definitely in the southern part of Ontario here on some awesome speaking engagements. Talk to us a little bit about that.
Yeah, exactly. So I was lucky enough to go to Ottawa recently to speak at the Aurea Reality event for 2024. So that was held in Ottawa. Geez, I can't remember the name of the convention center, but it was I think it was like a dome setup. It was just beautiful, and yeah, I was lucky enough to speak on the same stage as Magic Johnson and Damon John, the Shark Tank guy who created Fubu. So yeah, lots of wisdom was dropped, a lot of motivation. We also, some of the really interesting things came out of there, Gary, was the use of AI in our industry now. You and I have been sort of briefly talking about that, and the agents who are embracing it, and the concerns that realtors or just people in general have about AI. I don't know if anytime in the future I'm going to have some kind of AI avatar talking to the screen. I don't know. I feel a little bit weird about that. But yeah, a lot was learned, and there's a lot of positivity, I can say, this year about the direction of things, how the year has started a little bit stronger for most people, and the fact that I think there's some confidence coming back, like we've discussed, with the mention of rate drops happening this year as opposed to rate increases.
Yeah, yeah, and of course you are who you surround yourself with. So I like, you're my height. 5 foot, 5'5", 5'6" at best. And when you get to surround yourself with Magic Johnson, who's like 6'9" or 10, I don't even know. Interestingly enough, he was why I fell in love with basketball in the 80s, watching
Right.
Magic Johnson play. But that's kind of cool. And I have to agree with you. There is a little, we'll call it that cautious optimism within the market. And we can see it not only, of course, from buyers and sellers, but definitely within the industry, whether you're a mortgage broker, realtor, home inspector, whatever it is your role in the business. We do see that kind of positivity back in the market, which is important. And you know, this is why we have Dion on these calls, because he's just not another mortgage broker. He was invited by the Ontario Real Estate Association to speak on their behalf to all of its members. So this is pretty cool. This is our good friend. This is why Dion's with us. Okay, so
Cheers, bud.
we're going to talk about a few things here, my friends. And of course, some of that is, where are we going with rates? And we'll always have that conversation and just kind of keep our ear to the ground. But also we're going to talk about, and Dion and I have mentioned this in the past, housing starts and how the government is supporting that or not supporting that, or are they supporting that enough, and that type of thing. And there's a couple of things we're going to talk about. But let's kind of kick it off a little bit here. I saw this article, and that's not the screen that I want. It's coming. Don't worry.
Okay.
Here's the
All right.
screen that I want right here. And I thought this was an interesting question. You can find this on the Financial Post, but Dion is going to talk about this a little bit. Is the 5-year fixed mortgage dead? Not the rates, but that product, Dion. Talk to us a little bit about what's going on with kind of the favorite products at the moment.
Yeah, so look, I mean, traditionally, the fixed and the variable were what we were selling. Let's just go back, say, 3 years before the madness of COVID and other things. People always ask, should we go fixed? Should we go variable? And for various reasons, we would go one way or the other. But for the most part, it was a 5-year in both directions. It would be a 5-year fixed or a 5-year variable. In recent years and months, that 5-year fixed rate has been one which the majority of people have stayed away from. And that is because the rates are at such a high number, and there is an overall expectation that rates are at peak and likely will come down. So, using basic logic, why would we sign up for a 5-year when there's a good chance that within the next 1 to 2 years, rates are going to be significantly lower? So I can tell you that we have sold very few 5-year fixed rates in the last 6 months to 12 months. We have done a few for basic, for personalized reasons for people, but for the vast majority of our clients, they are actually taking either a 1, 2, or 3 fixed or a 5-year variable in the anticipation that as rates drop, that they will ride that rate down to some extent. And the other thing I should mention is if you do take a variable rate and you want to jump over to a fixed rate, that's a process called conversion. And you can actually stay with the same lender and jump from a variable rate to a fixed rate with no penalty. A lot of people aren't aware of that. So you can convert. You can't do it the other way, though. You can't take a fixed rate and then convert it to a variable without penalty. There will be a penalty associated with that. So some of our clients are taking that variable with the view to convert without penalty at some point.
Yeah, that's interesting. And that's all based on, from the bank's perspective, well, one's going to be paying more interest than the other, and they want to be able to, recoup that in a way or get you locked in, keep you locked in from that perspective. So, okay, we get it. And these are why it's important to ask these questions, not only as a borrower, but as a mortgage broker, as you are, Dion, to ask the client what's most important to you today as well as tomorrow, right?
Correct. Yeah, yeah. I mean, the simple example I give is, if I have a single mother on a fixed income, we're probably not talking about a variable rate. We're probably going to be talking about a fixed rate so that we can bring predictability to her monthly budget. But if we're dealing with a household that has a double income, that have their debt ratios covered well and truly, they're the people who can maybe take that more sort of speculative risk, but calculated risk, and say, okay, you know what, we are financially strong enough to choose this option because if A, B, or C happens, we're going to be fine. So again, yeah, it's not one size fits all for sure.
Great, great. Yeah, good stuff. And as for, we'll call it rate predictions in a sense, what's the sense between you and your colleagues about the, maybe a rate reduction in the future? Are we still kind of talking early summer months there, or where are we at?
Yeah, so I mean, again, if we go back a couple of months, the more optimistic amongst us, we're hoping for something to happen in March and April. It didn't happen in March. It's unlikely to happen in April. My position was it was likely going to happen mid-year, and that's still my position based on the data that we're seeing. Interestingly, last week the United States came out with some inflation data that was worse than expected. That in turn translated to the bond yield in Canada increasing. And there's actually discussion now about the potential for fixed rates in Canada, which are impacted by the bond yield, to increase maybe sometime this week. So, it's never going to be a straight line, linear line down as information comes out. These adjustments might happen. But overall, the sentiment is still, Canadians are hurting. And this is the other thing we've spoken about this. Canadians are hurting more than Americans because we have these shorter term mortgages, and therefore we feel the impact on our monthly budget much earlier than that American who signed a 30-year mortgage 20 years ago and is not worrying about that rate adjusting. So this may be the reason for the disparity in terms of pain. Like I feel like we're experiencing more pain in the Canadian market than in the U.S. market.
Good stuff. Yeah, excellent. Okay, let's talk about housing starts. And of course, last year was a record low year in housing starts right across Canada for obvious reasons. And in this year, I can tell you, I don't have the stats in front of me, but I do know that there has been more housing starts in this first quarter than there were almost in 2 or 3 quarters last year. So we're starting to see that, which is good. That's developers, selling their product and things like that. And part of that has a little bit to do with, and it's going to have more impact throughout the rest of this year and into next year. All of the housing accelerator funds. So you sent me an article here, Dion, and I'm going to share my screen. This is interesting. Markham plans to develop 1,640 affordable housing units near major transit stations in the next 3 years. Talk to us a little bit about why. Obviously, that's important on many levels, but let's dig a little bit deeper into this.
So again, if the big picture here is CMHC came out with an article basically explaining that we need to build somewhere between 5 and 600,000 houses nationwide every year up until the year 2030 for some level of affordability to return to the market. Okay. So basically, we just need to build more houses faster. And again, to put it in context, we're trying to build 550,000 with more than 250,000. Okay. This is a step in the right direction, right? Where, they're helping these things move a little bit faster. I know also, Gary, they're actually awarding more of this accelerator fund to cities which have met their criteria for quota for starts. And part of this is to try and get some of the red tape and bureaucracy, or expedite the red tape and bureaucracy so that we can get shovels in ground and houses built faster than later. But yeah, just to be clear, I think some of that affordable housing, though, it's going to be for a very specific demographic which qualify for that housing. Some of it may, in fact, end up being rental housing as well. And so I don't know that a lot of the what do we say? These programs are actually helping people rent for cheaper. I don't know if that one is the case, but it's not actually. Some of these aren't helping people buy houses, right? So I would like to see more programs that actually help people buy.
Yeah, exactly. And just to remind people what that housing accelerator fund, this came from the Canadian government and is nationwide. Really what they're doing is investing $4 billion into the next 2 years to by 2026, where we'll be able to build an additional 100,000 homes, which is awesome. And as we pointed out, and as you pointed out in prior videos, we basically need to be building 500,000 new homes a year, which is double the amount that we've ever done before to
Yeah.
meet the demand of affordability. So in essence, we kind of have to, if the government were to 10x this, $4 billion as an example, then we would see some major shift in affordability. So of course, it's a step in the right direction. We're not trying to throw, shade where needed, but there's a lot of work to be done, right?
Exactly. So yeah, let's hope they keep going in this direction. Baby steps are still steps, right?
Exactly. Okay, so the other article you sent me, and this is intriguing. We got a few things out of this. Let me just scroll up to the top, Dion. Okay, this is interesting. So Canadian renters are getting squeezed more than homeowners, putting the property ladder farther out of reach for those renters. Talk to us a little bit here, and we've got some things that we can bring up on screen as well, Dion.
Yeah, I don't think that headline is going to be a surprise to anybody. The people who have owned property have benefited from what I call the Ontario lottery, which is if you owned a house in the last 10 years, your net worth has jumped by maybe $500,000 simply by being in the right place at the right time. And if you were a person who wasn't fortunate enough to be owning real estate at that time, then that wave of increase unfortunately has passed. And so the question now is, where does this put people in terms of the spectrum of wealth? And I think maybe, Gary, if you want to pull up some of those slides or comments that you had prepped there.
Yeah, for sure. Give me a second here. This is a quote directly from this article here. And as you can see on screen, back in 2005, half of Canadians earned enough to afford to buy a home on their income alone. And this is incredible, Dion. Today, that is out of reach for 68% of Canadians. Reverse that for us. Talk to us from the other side what that looks like.
Okay, so what that means is only 32% of people who are earning income in Canada today qualify to purchase a property where they live based on their income. And so, I'll just big picture here, guys. Today in Canada, around 67% of people own their home. Okay, the balance are renters. That's as of today. What this is saying is if things don't change going forward, then that number is going to diminish because going forward and maybe over the next decade, only 32% of people will be able to buy based on their own sort of ability, right? So that's a huge disparity, a huge swing over the last couple of years. I remember, Gary, one of my very early mentors in the world of finance and real estate said to me, when I'm driving a car and my neighbor's driving a car and we're living in a decent location and we have time for our children on the weekends, everybody's doing well, everybody's doing fine. But when my neighbor can't afford that car or is working so hard that they can't spend that time with their family, that's when we start to notice some disparity in overall happiness, right? And this is the type of stuff that leads to crisis and, at the extremes, revolution, where people say, you know what, we're so far below being able to achieve the things that you're able to achieve because maybe you have this leg up, that, what's the point? We need to break the system. I'm certainly not saying this is the case here, but this is the way that these things start internationally, and we see this on the news in other countries around the world. We would hope that things don't ever get that bad, but this is certainly one step in that direction of that disappearing middle class, and the sense that I can't even get my foot on that ladder anymore, right?
Yeah. Yeah. And also let's provide a little bit of clarity on this quote too, is we're not saying only 32% of Canadians can buy a house today. What that means is, take as an example, I've owned a house for 20 plus years, 23 or 4 years. If I were to take any real estate that I owned away and then had to go buy a house, well, that would provide a tremendous amount of pressure on me because then I'd have to come with that down payment on my current salary. That's what we're saying. If you
Mm.
had to, take that away, so that creates obviously a huge shift in the market and what we're seeing with pricing.
Great.
The
I
next
think that
quote here,
exactly, that translates very much to the next quote that
yeah,
you have here.
yeah, there you go. Their first purchase Sorry, excuse me. The purchase of our first home used to be a rite of passage that came with building a family, but now home ownership is more likely to be associated with an inheritance or the transfer of wealth from previous generations.
Yeah, and again, we've been talking about this for so long now. So back when I first started in this industry in Canada, it was around 2008 9. I was in an office in Scarborough at the intersection of Victoria Park and Shepherd. And the reason I'm pointing this out is because that area, if you were to draw a 5 to 10 kilometer radius around that office, what you would have is you'd have a lot of new to Canada immigrants who were working a lot of blue collar jobs. And one of the greatest joys I had in my job at that time, taking these people who were making 30 to 50 grand a year and helping them become homeowners. And they were, in many cases, the first homeowner of their family ever, right? Their first generation, especially in this country. So the challenge now is if you would go back to that same location, those people in that area are making maybe slightly more. Maybe instead of 50 grand, they're making 60 grand, 70 grand. But unfortunately, those house prices are at such a point where, they can't make those same steps in a real estate that the same people were making just 15 years ago. And I know that, a lot of people, feel like, you graduate, you get married, you buy your house, you start a family. And we used to, let's just say, we used to be able to bootstrap it all by ourselves without assistance from outside. But again, I know, and in your business, that a lot of the first time buyers that we are helping buy can't do it by themselves anymore. And you know what? If I go back to that same example, I have seen those same people who I helped 15 years ago understand that. And now they're actually taking equity from their home and then gifting it to their kids or writing them a check for the down payment, understanding that the playing field that they're on now, that their children are on, is not the same playing field that they were on 15 years ago. So it's just understanding that now is part of what is the norm.
Yeah, the interesting thing too is, and people are passing that wealth on prior to death. It used to be we have to wait to death for that wealth to be transferred. Now we're seeing the early signs of that being transferred beforehand. The piece that perhaps we should talk about a little bit more or have some roundtable discussions or for is, okay, that next generation. If you and I have transferred a down payment as an example to our children in 25 years of ownership of those children, what happens to that next generation? How does that keep going down? Because that gap will get smaller and smaller, or that wealth gap will get smaller and smaller. So it'll be really interesting to see what happens. And that's, say what you will. Sometimes government intervention can really throw a wrench into things, but that's why we do need government intervention. It happens every day in real estate. So if you think it doesn't, you
Yeah.
got to check yourself, because who controls our interest rates? Well, that's the government, right? So they're already in it. It's just a matter of how do they make it more attainable. Speaking of attainable, Dion, we've got
Mm.
another slide here, and let's bring that up. And this again, you shared this with me. It's out of that same article we were just looking at. This really breaks it down between home ownership and renters. So walk us through this graph here.
Yeah, so you got three bars here. On the left, you have homeowners. In the middle, you have renters. And on the far right, you have renters who used to own real estate. Let's start with that one because when I read that, I was a little bit trying to figure out how did that happen. So renters who used to own real estate. My guess here is that a large portion of those people, Gary, are people who potentially are unfortunately divorcees, and we see this a lot in our business. I'm sure you do too, where unfortunately, we've got this marriage breakdown rate of somewhere in the 50% range. If they own a property together, what often happens is, that asset is sold and each of those parties is off to themselves to go and buy their own property. But just as discussed, a single income isn't allowing people to buy property, even with a large down payment today. So I feel like a large portion of those people in that section are probably former homeowners. Okay, so if we just focus now onto the two left bars, you can see that huge disparity
Mhm.
between the wealth of homeowners and the wealth of renters. Everything above the number zero on that line is everything above it is assets, and everything below it is liabilities. And as you can probably imagine, the homeowner, as you can see there, guys, has much more liability than the renter. And of course, that large yellow section below the number zero there is mortgage debt. Okay. So mortgage debt or any debt, and I'll tell you, if I go back to my very early stages in the world of finance, in my mind, debt was bad. Debt was a bad thing. But once I learned that debt allowed us to control assets and that those assets will in general terms grow in value, then the access to that debt is the access to the ability to grow your net worth. And so what you can see there is that those homeowners who, yes, they do have certain level of, well, 200 grand or so of debt overall, more so than the renters who have next to nothing. On top of the zero line there, what we have is assets worth well over 1.4, 1.5 million. And yeah, that orange section there that Gary's just highlighted at the top, what is that? That's real estate equity, right, or ownership in the value of real estate. Um, Gary, why don't we talk about that really interesting same orange line in the renters world?
Yeah, that was intriguing. You and I were looking at this, and all of a sudden, you kind of had that aha, like, hang on a second here. So,
Mm.
if you're looking at this middle section, that renters column, there are a handful of renters that do own real estate, and this is an important piece of generating wealth. And I know I've helped people in the past where they could not buy a house where they live or where they work because the real estate prices, that we talked about many times, are at a reach for them. However, they do understand the value of real estate, so they would buy an income property, whether that's an actual investment property or a cottage or something. They are in the real estate game. And just because you think of that mindset, no, I'm a renter, I'll always be a renter. Well, look at the graph here. Look at the two columns and how lopsided it is in generating wealth. And maybe start have those conversations. Perhaps we should buy an investment property in a market where our dollar goes much further. There's even in the GTA, if you're working in Toronto, you can get out into those outside markets like a Barrie or down into Hamilton or into Oshawa, that type of thing. There are options for you if you wanted to have that conversation, Dion.
Yeah, and what I find is that a lot of the younger people who are buying investment property are doing so under the guidance of their parents, right? So I
Mhm.
have clients who are in their 40s and 50s who have children in their 20s and saying, you know what? We know you're not going to get married for quite a while. We know that you can't afford to buy in a location where you need to live. So let's combine forces and let's go buy some real estate potentially together or facilitate them buying it themselves. And yeah, I think it's a great entry point in that, you know what, for the next 10 years while you're building your career and maybe building your relationship with your future partner, at least build that equity, right? So it's nice to see that even some of these renters are still homeowners or property owners on the investment side of things. And that stat there, Gary, came out last year that 15% of property investors do not own their principal residence, which means they fall into that category that we're talking about there.
Yeah, exactly. So, and of course, this whole podcast and video series is of course, highlighting the mortgage industry and your mortgage products and how to, what mortgage products to get for your home and what's best for you. But it's also about generating wealth and taking care of you and your family. And it's as clear as day here. Canadian homeowners net worth 4 times higher than renters. Okay, we understand that, but it doesn't have to be so if you are a renter. And yes, Deanna and I are somewhat biased in the sense we've generated wealth ourselves through real estate and we've helped other people do it. But I think the biggest thing here, Dion, is start thinking about tomorrow in a sense of how can I invest and take care of my future self, as it were. And there are other ways to invest in real estate other than owning tangible real estate, right? And that's just the point that I want to make, is whether that's through REITs or investing into mortgages and that type of thing. So do reach out to Dion from that perspective if you don't have the means today to own a property outside of where we talked about. There are other ways, and let's have those conversations, right, Dion?
You bet. Yeah. I mean, in the current market too, we're helping a lot of people take the money that they have and invest it into mortgages in first or second position. It's interesting, Gary, the way that mortgage qualifying has gone in the last couple of years, where the qualifying rate is so high with the stress test. I see very good people with good income and good credit who just simply can't qualify for regular mortgages now. And the realm of private lending used to be seen as, oh, we're lending to people who are less than perfect with income and credit. We're now lending to people with perfect income and perfect credit, but they just can't qualify based on the banks and government's criteria now. So it seems like the risk profile for investors is actually quite a lot lower now in terms of who they're lending to. So yeah, maybe if, on a future episode we can talk about some of those projects that we've helped people do.
Yeah, definitely,
Mhm.
definitely. So, my friends, there is always a lot happening in our mortgage environment right across Canada. More importantly, though, is looking for opportunity, and of course, that always comes up in real estate. If you need there's always 3 questions, and I'm going to come back to these 3 questions, Dion. If you're just starting out in real estate, use these 3 questions, and both Dion and I can help navigate what these conversations look like. And that is, how are you going to buy that property? So the mortgage and the down payment and so forth. How can you add value to that property, even if it's your primary residence? You can add that sweat equity or what have you. And then, of course, how are you going to sell that property? How are you going to exit that property?
Yeah.
And those are those 3 questions. Think about those 3 questions. And as I said, Dean and I can help you navigate through that. Even if you've owned a property for 20 plus years, maybe you haven't thought about what it looks like to sell or buy a new home, because things do change every day. And it's important to have these conversations. Dion, remind us how to get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Beg.
The Dion Bag. That's the man. I'm Gary McGowan. We'll see everybody in the next episode. Bye for now.